Hi, class. Chapter 13. You've got a pretty good handle now on assets, liabilities, equity, income statement, inventory, receivables, some of the current asset stuff we've been talking about. Now we're going to get into financial analysis. And the big categories and methodologies for financial analysis we're going to cover. I'm going to go ahead and share the screen. And we're going to take a look at three major areas. First is going to be horizontal analysis. Second will be vertical. Third will be ratio analysis. So let's talk about each one of these. You remember our pictures of revenue and expenses. You remember our pictures of assets, liabilities, and equity. We've got the debits and credits down. We've got the retained earnings statement down. But we're going to be doing some comparisons. Now, horizontal, another name for horizontal analysis is trend analysis. It's basically time period associated. So if we're looking from last year to this year, let's take a look at that. Let's say if I had sales, current year sales of 12 million and prior year sales of 10 million. So how do I handle the trend? Well, we know the difference officially is $2 million, change of 2 million. But when we're looking for a percentage, which is what we're going to be analyzing, we're going to take the current year, subtract the prior year, and divide, and here's the key, do you divide by the current year or prior year? Well, if we're doing the trend from last year, we're going to put the prior year in the formula. So we're going to take the previous amount, and so in this case, we have 12 minus 10, parentheses in, divided by the prior year, which is 10. So that gives me 2 over 10, which yields 20%. So I went up from $10 million to $12 million, a change in $2 million, which is a 20% increase since last year. So that's our horizontal analysis. That's our time period. That's the breakdown. We also have our vertical analysis. So we take our vertical analysis, also known as common size. Remember how we talked about how Walmart, for every dollar's worth of sales, they might put 2.5 cents in their pocket? For Apple, for every dollar worth of sales, they put 21 cents in their pocket? That's vertical analysis. That's common size analysis. It's much easier to read a income statement and compare it to somebody else's. So if I compared Kohl's to Belk's to Walmart, and I wanted to see, well, total revenue, I assumed that was 100%, and I looked down at the bottom line net income, I can come up with a net income percentage. I can come up with a gross profit percentage. This is all with total sales or total revenues in the denominator, and then whatever number or part of that income statement in the numerator. So let's demonstrate that. So if I told you that we had $500 billion in sales, which Walmart does. And I'm going to put total sales. Remember, we had to add all the revenue sources. If we had membership revenues, interest revenue, we had all that in the income statement showing. And then we might have had cost of goods sold. Let's say we had 300 billion. Cost of goods sold. What's our gross profit? Well, 500 minus 300 gives a 200 billion gross profit. And then if I told you we had SG&A and our selling general administrative might have been, oh, let's say we have 190. SG&A, selling general administrative. That should yield a net income of what? What's 200 minus 190? We got $10 billion net income. So if I do vertical analysis, I'm going to take my total sales in the denominator, and any one of those numbers I could do vertical analysis on. So if I did net income over total sales, and I did 10 out of 500, which is the same as 20 out of 1,000, that would be 2%. If I decided to do a gross profit percentage, and I took 200 out of 500, you say that, okay, that's 2/5. That would equal 40%. So if I was going to compare Kohl's and say, oh, Kohl's has a 3% net income percentage, even though they have a lot less billions of dollars in sales, and a lot less $1 billion in gross profit, and a lot less $1 billion in net income, I can easily see for $1 worth of sales, Walmart gives me 2 cents profit, and they cost 60 cents cost of goods and 40 cents worth of gross profit. And then I can compare that and maybe Target. And I might have Target might be a little more profitable at 3% net income, but their gross profit might be a little bit less because they have higher ticket, higher costs than Walmart does overall. So that these numbers tell a story. There are two vertical tendencies that we look at. One is on the income statement. And on our income statement, our 100% number or our denominator is going to be total sales. On a balance sheet, our 100% number is total assets. So when we looked at inventory and we actually talked about Big Lots and said, well, 50% of the assets of Big Lots happens to be inventory. Well, compare that to Walmart, which might be closer to 30 or 32%. Or compare that to a different store, and you can see what their inventory impact is. Or fixed assets as a percentage of total assets. Or receivables as a percentage of total assets. Or even cash. So any one of those numbers can be compared to total assets, and our total assets is what's going to be in the denominator, and whatever number is in the numerator. So that's how we're differentiating between horizontal and vertical analysis. So again, horizontal, comparing the financial condition and performance across time, year to year, or over 3 years. Last year we went up 5%, and this year we went down 3%. That could be on net income, that could be on sales, it could be on gross profit, it could be on a multitude of line items. Our vertical analysis compares the financial condition and performance to a base amount. What did we say our balance sheet base amount was? Yep, total assets. We said our income statement total amount was total sales. Those are 100% numbers. Everything else is a percentage of those. And finally, we get our ratio analysis. And our ratio analysis measures key financial ratios. So what kind of ratios are we talking about? We've got 4 categories, and I'm going to emphasize 3 here. We have liquidity ratios. How liquid are we? How fast do we turn over cash or get our cash? We have profitability, which if it has net income or profits in the formula, it's its profitability ratio. And solvency is more of a long term. So if I'm analyzing and I'm looking at things like liquidity, that means anything to do pretty much with current assets or current liabilities. So I might look at my current ratio. I might look at my inventory turnover, days inventory, receivables turnover. And so anything associated with liquidity, usually current assets or current liabilities, and receivables and inventory obviously are current assets, that are considered liquidity ratios. How liquid are we? How quick can we pay things? How quick are we going to turn things to cash? When I look at profitability ratios, I'm going to look at things, anything that has the word net income or net earnings or just earnings or net profit or return. So I might look at ROA, return on assets, equals net income over our return over average assets. I can do a return on equity, equals net income over average equity. Remember, we need to take that average because net income is for a whole year. But the assets themselves are 2 points in time, so we take an average of those 2 points. I might have my net income percentage, which is similar to our vertical analysis, our common size statement. And we said Walmart was about 2.5%. That's your net income percentage. And again, that was net income divided by net sales. And you're saying, okay, oh yeah, that's right, my sales is my 100% number. So anything in the numerator is going to be a percentage based on that. So that's how we look at that. Or I have EPS. Earnings, again for the year, over average number of shares. So these are all profitability ratios, and the name of the ratio tells you what it is. Earnings per share. Return on equity. Return on assets. So these are things, anything that has return, net income, earnings, or profits in the name of the ratio is going to be profitability and analyzes profits. Okay. And by the way, we have to deduct here our minus preferred stock dividends, which we haven't gotten into yet, which is in chapter 11, and we'll talk about it. Don't worry about deducting the preferred stock dividends or any stock dividends, not the common stock, but just the preferred stock. Don't worry about it at this point, but just want to make you aware. And so the market prospect, anything with the stock-related stuff, and we might have, there are all kinds of measurements for price of stock, so price to earnings ratio, or price associated with dividend yield. So that's with market stuff. Profitability, anything with net income, anything with profit, anything with earnings. Solvency are usually long-term liabilities and total liabilities, total assets, the big picture, the big tickets, and liquidity and efficiency is associated with current assets and with current liabilities. So those are the big categories. And I do expect all my students to memorize most of the ratios, but you see that the names of the ratios are self-explanatory. The one that might get tricky is current ratio, that's current assets over current liabilities. And inventory turnover is made up of two things. It's made up of obviously inventory and cost of goods sold. I want to ask you, which is a bigger number? Well, inventory goes up, goes down, goes up, goes down, goes up, goes down, while cost of goods sold goes up, 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 and keeps growing. So cost of goods sold is the bigger number. I'm going to have to divide that out by average inventory. And when we look at average inventory, we're saying, oh, so my bigger number, my cost of goods sold is 100 million, and my average inventory is 20 million. That means my inventory turned over 5 times that year. And we talked about inventory turnover already. And 5 times in a year, 365 divided by 5 is roughly 73 days. 73 days. About every two months in a week are 100% on average our inventory turns over. That's how that works out. That's what that looks like. So let's go through some of this other analysis. So information for analysis, we're looking at the income statement and balance sheet. Statement of stockholders' equity, which includes retained earnings. Statement of cash flows, and our notes to financial statements. So that's where we're going to be reading about what's going on, and you're going to be reading an annual report cover to cover, which is why we're jumping chapter 13 early in the picture. And then we have different ways of different methods of comparison. We can compare intra-company within the company, or intercompany between other companies and competitors, or within an industry standards, or other guidelines that we might have. When economic conditions are down, I mean, we have COVID going on, and if that happens and everybody's affected by it, then it's like the rising tide raises all ships, and the lower tide lowers them all. So if we go ahead and we get horizontal analysis, review of financial statements over time, we just talked about. And again, this will reinforce what we talked about, the dollar change, the analysis period amount, the future amount, over the previous amount, the base period amount. And you divide that by the base period amount. Multiply by 100%, so we're trying to get percentages. And then trend analysis. We have the analysis period amount. We might have had $5 billion out of $500 billion. That's 1%. 5 million out of 500, 1 over 100, that's 1% analysis on net income percentage. That was, last year Walmart was about a 1.3, 1.5, I think. And then the most recent year was about 2.5, 2.6, I think. But they more than doubled in revenues. I'm sorry, doubled in net income. They increased slightly only in revenues. Vertical analysis, base amount, as I mentioned before, in a balance sheet is total assets. That's your 100% number. On income statement, it's total sales revenue. Then we have common size, and the pie chart kind of pictures that out. So we have the bottom line net income, in this case, 19.8%. We have cost of goods sold or cost of sales. Same thing, just another way to confuse us. 61.5%. Taxes almost 7%. R&D 5%. SG&A 6.7%. So that's just a relative that it makes 100% pie. And that 100% pie is our total sales revenue. Ratio, we looked at the building blocks we talked about already. Liquidity, profitability, solvency, and markets. So asset test, current receivable turnover, days sales inventory, days sales uncollected receivables, and inventory turns. So those are all current assets like receivables, inventory, cash, and total current assets and total current liabilities. Working capital is just taking a subtraction, current assets minus current liabilities, not the current ratio, which is current assets divided by. There's our current ratio. Asset test pretty much excludes prepaids and inventory. It's the very, very liquid stuff. Banks use the asset test ratio. Why? Because they really don't know what the value of inventory is. If they go to a wine shop and say, oh, you got a bunch of bottles of wine on the store, those are 10 years old. Is it vinegar and worthless, relatively, or is it vintage and gone up in value? That's not the job of the bank to figure that out. They're going to just take inventory out of the mix and calculate an asset test ratio, also known as the quick ratio. So banks like to get rid of inventory, and they like the asset test ratio rather than the current ratio. They don't know if the inventory is obsolete, if it's broken, if it's still good, if it's been hanging around for years, or just hanging around for days. Receivable turnover, same kind of thing. We get sales and receivables. That's our selling price sales and receivables. Sales keeps going up and up and up. Receivable goes up, we get paid. Goes up, get paid. So the larger number is in the numerator. The smaller number is in the denominator. Is a good way to remember it. But now you know it's sales and receivables. How fast do we collect on our sales? Inventory turnover. We just talked about how the cost of goods sold keeps going up and up and up. And inventory goes up, down, up, down, up, down. So cost of goods sold is 99.9% of the time a bigger number. And our average inventory is smaller. So we can turn over 5 times a year, 10 times a year, and we determine. And you notice the average inventory. Again, we're mixing an income statement amount, cost of goods sold, and a balance sheet amount, average inventory. Days sales uncollected. I prefer another method to calculate this. I take my receivable turnover and divide by 365. They just kind of flip this. They take not the net sales over receivables divided by 365. And they don't take an average here, okay, AR. And this is the way the finance folks do calculate it. Usually accountants calculate the way I just mentioned. Either way on a test is going to be fine. But the formula of receivables divided by net sales inverted times 365. Rather than what I would like to do is I take net sales over average receivables and divide by 365. It's going to come out pretty close. Days sales inventory, same thing. Ending inventory divided by cost of goods sold times 365. Asset turnover. Sales over average assets. How many times have we sold our assets? If we had $100 million in sales and $50 million in assets, our turnover would be 2, which means we sold our assets twice. We sold $100 million worth of stuff, and we only had $50 million in assets. That means we doubled. We sold all our assets twice, and that's another solvency type measure to go. It's not a profitability measure. There's no net income here. It's not liquidity measure. It's a solvency. It's a big scale, big ticket kind of thing. So debt to equity. So we have total liabilities over total assets. We have our equity ratio. We have debt to asset ratio. Debt ratio is the same thing. Total liabilities over total assets. So how much of our balance sheet is debt and how much is equity? That's going to equal 100%. So if we have 70% debt, 30% equity, we got 100% in assets. We have a 70% debt ratio. Our debt to equity, though, is 70 over 30 at that point. So you take 70 divided by 30, and that's 2 point something or other to get your debt to equity ratio. And there's an example there. Total liabilities, total equity, and dividing it out. I'm sorry, total our debt ratio, and then our debt to equity ratio. Total liabilities over total equity. We got profitability. It has the word return, has the word profits, has the word earnings. Those are all profitability related. Okay? Profit margin net income over net sales. Now, I didn't take any average net sales or average net income because that's for a whole year. I don't have any balance sheet items in there. So there's our profit margin. Return on assets is different though. I have net income still in the numerator, but I have to take an average of those total assets. And we're good. Return on equity, the same thing. Net income minus preferred dividends. I didn't have to do that preferred dividends thing here on return on assets, but I do have to do it when it comes to equity and return on equity because we're taking out preferred dividends because there are special kind of dividends. A lot of companies don't have preferred stocks, so they don't have preferred dividends. All companies do have common stock. P to E ratio, price to earnings, market price per common share over earnings per share. So the price divided by the earnings. So if we have a price of $300 for a share of stock and we have earnings on that share of $100, I've got a P to E ratio of 3. The high-tech companies actually usually have higher P to E ratios. Utilities, banks usually have a lower. And I'm going to throw this chart at you. All these ratios you should be reasonably familiar with, reasonably comfortable with. The only ones on here that I don't worry about are dividend yield, and I don't worry about book value per common share, and times interest earned. There are 3 on here that I don't expect my students to memorize. Ideally, you'll have these, and most of these are pretty self-explanatory. You've seen them, most of them already as well. Total liabilities, total assets, debt ratio. We're doing net sales over average AR, receivable turnover. Current ratio. We've got profit margin ratio. You see these ratios, and all of them are pretty self-explanatory and hopefully make some good sense as you review and as you understand. All right. I will mention when you have, what is the best predictor of future income? Operational income. You got one-time stuff and adjustments. You might have, you have your continuing operations, net income from continuing ops. But then we have some changes. We discontinue segments. That's kind of called below the line stuff. You might have something called earnings before interest, taxes, and amortization. Interest, depreciation, amortization, EBITDA. And you take depreciation out of the mix, you take amortization out of the mix, and you take the other unique things, interest out of the mix. So continuing operations is the best predictor of future performance. And what can we predict? Well, we sold off a division, that division's gone, that's a one-shot deal. We either made money or lost money when we did that. But we had revenues and expenses from our mainstream business, and that's the stuff we should be able to count on and or rely on for further predictions. So that's the overview of chapter 13. Hopefully you got a picture and get a feel for that. We'll talk some more about analysis and when we get to more discussion of your projects and how we're going to do that. And I did a little bit of demonstration with Edgar. You want to get comfortable with Edgar. Edgar is a powerful tool. It's an area that you want to be familiar with, and it's something you can use very quickly, very easily, and does make a lot of sense. Thank you for your time, and if you have any questions, I'm at your service.